Analysis, gold, silver and Bitcoin monthly update for June 2025. We're putting this presentation together for our valued clients of the Ainslie Group, including Ainslie Bullion, Ainslie Crypto, Ainslie Wealth and the Gold and Silver Standard. We've got a jam-packed show for you today. We've got our panel as per usual, Joe and Paul. Welcome. There's been a lot going on. There's been a lot going on even just this morning before we recorded this. How are you both today?
Dizzy.
Dizzy.
So much going on.
Drama.
There has been a lot of drama, and that's a point that we'll be discussing: drama versus, just some of the hardcore facts that we've been following. We'll get into all that. I'll start off with our usual disclaimer, reminding everyone before we begin the analysis that everything said and shown in this presentation is intended for general informational purposes, does not take into account your particular circumstances, objective or situation, is not financial advice, and you should always do your own research and consider obtaining independent advice before making any investment decisions. As we were just sort of saying, there's been so much going on, but what's really helped us through this, I think, is structure. I'm going to put that out straight away. That's why I'm sort of lingering on the overview page. The structure has helped us, I think, through a very challenging time in the markets where we've had so much noise. I would argue probably the most noise I've seen in the markets since COVID, at least, where you really, if you were listening to narratives, you would really have gotten caught up. So I think it's held us in good stead, and I think that's a good reason to continue that path, I suppose, of really not so much listening to the narrative, but following the data. And when you look at that data, if we start off with where we are in the cycles, really not that much has changed for quite a while. We're still potentially, or we see that we're increasing with global liquidity, but we're still potentially in that early sort of mid-cycle chop that we've had. And the Bitcoin cycle we'll talk about shortly with this bear market signal, but we were sort of choosing to ignore that. Joe, do you want to start us off maybe with your view, looking at those first 2 points, the idea of where we are in the liquidity cycle and the macro cycle really not looking like war at all?
Yeah, well, as you pointed out, there's been a number of geopolitical events this year, and it all sort of started with, well, first of all, Trump coming into office, and then basically what it looked like he was trying to crash the stock market to get bond yields down, and they ended up reversing course on that. And then there was tariffs, and now there's the war between Israel and Iran, and that sort of seems like it's blown over this morning. But in terms of impact on markets and liquidity, as we've been saying probably since the end of last year, it's going to be quite challenging for a number of reasons due to the stop-start nature of liquidity, and that flow-on effect and the geopolitical uncertainty in markets has really sort of handicapped investors' confidence in terms of risk appetite. Risk assets are still done very well, and even with all that going on, and and that's largely due to the fact that we are still in that early to mid cycle, where inflation's still somewhat subdued. Growth looks like it was picking up for a little while there, but it's sort of come back, and that's pushed us back into that early cycle. But at the end of the day, we've got liquidity expanding there. You got our little blue dot there above the expansion line, and that's what we're using as our sort of true north to keep us in the markets and sort of phase out everything that's happening in the news.
Paul, we had an interesting discussion about this yesterday. This idea that if it was a different phase of the cycle, the exact same news would have resulted in a very different outcome for markets. What's your take on that?
Yeah, absolutely. I mean, the cycles are cyclical, right? So we know where we're looking at all that blue and green, that we are clearly not even well into a mid-cycle, let alone having any remote fear about this being late cycle. So if we were late cycle and we were getting the sorts of things that are happening at the moment, then absolutely we would be taking a very different view. But this framework allows us that we're from a liquidity point of view, we're barely above 50. From a macro cycle point of view, we're barely, we've gone back to early. That's how teetering we are between early and mid. So it just gives you the clarity of thought to park all the noise to the side and look at what's really driving markets and look through it. And it's held us in great stead so far, and it will continue to do so.
And Paul, to that point, when you look at this chart, we had this signal that was suggesting the bear market, right? That we've got a signal from the momentum indicators, the various indicators that comprise this, to suggest that Bitcoin could go down. We chose to ignore that. Do you want to step us through the thinking around that?
For precisely what I've just said. So we Bitcoin, the bull markets, it's in the name. They can buck, and nothing bucks like Bitcoin. So we do get these get these big drawdowns. But you go back to that previous chart. It has been stuttered in terms of the turnaround and liquidity. But the trajectory, when you just draw a line through all of that previous page, you can see is up and to the right. So when we see these drawbacks, we just test ourselves. Where are we at? And as I said before, if we were late cycle, we'd be looking at this very differently, but we're not.
And that really has been our greatest success, is knowing which of these to ignore. We're going to be paying a very different level of attention to that signal in particular if we thought we were at the end of the cycle. So it's going to take on a whole new meaning, probably similar to the whole discussion we're just having around the same news would have resulted in a very different outcome. It's the same for us. The same indicator results in a different outcome depending on the entirety of the background. Speaking of that entirety of the background, we've got the deep dive on the global liquidity cycle is the driver. We've said this quite a bit. Joe, I'll ask you sort of for your perspective on the current state of this. But if you look back, we've just had a very consistent pattern over a long time that has allowed us to build this confidence of where we're heading. You can read more about that, sort of looking through our reports at ainsleewealth.com in the research section. But if you look at the current data, the liquidity has been choppy, which probably has led to the macro cycle being choppy as well.
Yeah, and it goes back to our fundamental belief that liquidity is what drives markets and markets drive the economy. So we did a episode a couple of weeks ago on Beyond the Block where we're really outlining the fact that a lot of consumer spending comes from the top half of the wealth in the US, and a lot of their wealth is in the stock market, which is obviously impacted by liquidity. So when they feel like there's a lot of when they feel asset rich or their assets are going up, they generally spend more in the economy. And as bad as that sounds, like it's that's the truth, and that's the nature of the US economy, right? So when you've got the wealthy, well, the top 50% spending, that's the income for the bottom 50%. So like it makes a lot of sense.
And we've had a lot of noise in social media recently around probably a misconception of that. I know you certainly have opinions on it around people who think, well, the rich don't pay any tax, for example.
Mm. Yeah, well, exactly right. So at the end of the day, it goes, like I said, if you can tax the rich, right? But to tax them means that you're going to cut back on their spending, which, yes, the government may be able to fill up the TGA because they've got more tax revenue, for example, but you also completely stall out the rich spending. So I think there probably is going to be somewhat socialist legislation coming into the US over the next 4 to 8 years, where there is probably some sort of wealth tax implemented on the wealthy, only enough to sort of marginally affect them, which wouldn't necessarily stop spending. But at the end of the day, all that means is that you're transferring wealth from the wealthy to the lower class, and generally speaking, the lower class will spend that money, and then you get those more inflationary effects, particularly when you've got government deficit spending as well. So that's sort of why we do lean over the next period of time, the next cycle, that we are going to see inflation starting to pick up, simply because, yeah.
Yeah, we'll talk about inflation in a second. And Paul, it's certainly not a US only phenomenon for our Australian viewers. It's something that is increasingly getting some airtime. This idea of wealth taxes, and you're really trying to transfer some of that from the top of the pyramid to the bottom.
Yeah, absolutely, and it's a huge theme that we've got the chart that we often show with monetary growth versus CPI growth, and if you're the ones holding the assets that benefit from it, then you get wealthy, and if you're the ones that are in the CPI economy of wage growth and cost of living, then you just don't. Just before we leave this chart, because it's a great one to give a snapshot, To put into context, just this grind out, that last cycle you can see was only 4 years. So these are generally around 5-year cycles, and it was also extraordinary, like unprecedented in terms of the quantum of stimulus that came into the economy and the coincidence with supply-driven inflation rather than monetary-driven inflation. So you would expect to come out of something so extended and so short that you're going to have a grind out, and we a lot of that is the quite incredible extent of monetisation by the central banks and them just trying to get that off their balance sheet at the moment as well. But that's a good chart just to show you just the extent of that previous cycle. It was short and very sharp.
Yeah, that is a great point, because recency bias makes us believe that we're always going to get a very clear up and down curve that is not necessarily the case, and that's why it requires us to be a little bit more on the ball to be able to pick what's actually going on, which leads me to the next part of this, which is where we sit with the central banks. We bring this chart up all the time to show that, well, it's not just about central bank money. And I think even there was a post from Zero Hedge, tongue-in-cheek, sort of saying, oh, where are all these M2 Bitcoin correlation charts? Which is a point we make all the time, right? That ultimately M2 is not going to tell you everything you need to know. It's a broader picture than that. Digging into that a little bit more specifically, though, it is still a significant component. It still gives you an indication of which direction we're heading. And the broad picture here is mostly green, but when you dig into the specifics, the majors, it's still not looking overly positive there. You don't have a whole lot of central bank liquidity that's helping to at least ignite this fire.
Yeah, absolutely. Oh, yeah, I was just going to say, in a way, like that's very encouraging that all the liquidity has basically come through the private sector, either through the Treasury issuing short dated bonds, for example, or just M2 being created, which obviously does help, and we do factor a portion of that in. So there's really only one way that this chart can sort of go, and that's most likely more into the green.
Paul, do you think that, to Joe's point there and to the Zero Hedge point, really, it doesn't show up in M2 at the moment necessarily because there's a bit of cheating going on as well?
Yeah. And we've got to look at what's driving. Joe just touched on it. If we remind ourselves that global liquidity is really the balance sheet of the financial system of the world, yes, central banks are decent size. You could see 12% in that previous chart. But a lot of it's the bond market in terms of the collateral for that balance sheet, and bonds have been weakening, with these yields going up. The volatility is coming down, so the LVR is getting better. But the good old US dollar has been a big contributor to this, with it coming down. When you've got $360 trillion of debt in the world, a lot of that's US dollar denominated. It's a big factor. So the simplistic M2 optics of this that aren't, as Zero Hedge suggests, isn't playing out at the moment. There's a whole lot of factors. It's a complicated beast.
And this data is sort of a week out of date, but it's just showing this general idea that we are still at the weekly level in raw dollar terms substantially higher than we were 12 months ago in global liquidity. But I mean, you both made this point multiple times. It hasn't been a smooth ride, and part of the reason it hasn't been a smooth ride relates to that last point, that central banks haven't really come to the party yet. Even though we can see that nominally we're higher, it's been a bit of a choppy journey. I think part of the explanation around a lot of this comes back to the bigger picture around the global macro cycle. So the deep dive on that is the next logical place to go, because we start with the liquidity driving it all, and then the global macro cycles where we follow. Joe, you've been sort of looking quite a bit at this concept of where the growth is going to stall out here. I think there were some concerns that the geopolitical stuff was going to get in the way, but if that's sort of pushed aside, you could look through this chart and say, well, we're probably ready to head back into a little bit more growth. What's your view on growth generally? Obviously, this is US data, but sort of extrapolating out to the rest of the world as well.
Well, touching on those geopolitical events, for example, like we had oil come off like 12% this morning, right? So obviously higher oil prices can impede growth somewhat because oil and energy are an input for absolutely everything. So if oil's quite high, that's when the cost of everything goes up, which, at the end of the day, yes, it raises inflation, but stunts growth. But back to our original macro chart where we are in that early sort of cycle, like we've got lagging growth and we've got somewhat subdued inflation. Now we do expect inflation to pick up and we do expect growth to pick up on the back of just government stimulus. Like you've got China at the moment who are basically going through a deflationary period. They've got bond yields at 1.5% or whatever it is, their 10-year. So they're trying very hard to stimulate the economy. And I can't see how the US isn't going to want to do that into next year as well. So if you're just throwing money into the economy via policy like the Big Beautiful Bill, then how does that not drive economic growth? Unless you
and you're starting to see that through that leading indicator potentially, like it's suggesting that we maybe did see the low already because that combines things like forward orders and inventory to work out, okay, our inventory levels falling, so they're going to have to order more. Forward orders are coming in, so it's looking like that could have been it.
Yeah, particularly like back to my point around asset prices and their impact on the economy, which is a derivative of liquidity. If you've got rising asset prices and you've got services which make up a huge part of that chart, for example, like the wealthy are going to spend. If asset prices go up, the wealthy are going to spend. Everyone's receiving income from that spending, right? So generally speaking, like nothing's for certain, you would assume that economic activity within the US economy is going to pick up.
Yeah, it tells the story perfectly in terms. You said it before, Joe. Like the market leads the economy. So if we're in an environment where we've had a knock on the manufacturing part of that through tariffs and China's weak and that sort of thing, then that makes sense. Services has been strong because it's 60 to 80% of the growth sector, and it's been strong, and it's counter-cyclical as well. But as that liquidity comes in and that services wealth effect flows through, and then you start getting manufacturing, you can see the trajectory. You can see why that arrow is coming up, because it's exactly what we're saying. The liquidity drives the markets, drives the economy, and manufacturing is lagging just because of the many hits it's been taking of late. But services is going to carry it through, I think.
Yeah, and that all feeds on each other. It becomes like a self-fulfilling prophecy, right? Because once confidence is back, like it can take a while to get back after such events that we've had earlier in the year. But like once it gathers steam, it stays in expansion for quite a period of time.
Paul, I was curious about the intersection of this chart with that conversation that we're just having, because this has some modelling on the end, some AI modelling that comes out for cross-border capital, projecting that where the high or where the cycle turn might be. It's not necessarily the highs that we saw last cycle, which you mentioned before, like that made sense. Do you think the growth story sort of plays into this a little bit, that it might not be robust growth necessarily? It might just be there might be growth, but it might not be this sort of knock it out of the park type of growth. How do you view what the potential setup is if this modelling is correct?
I think it just makes sense. As to my point earlier, when you come off something so extraordinary as the last one, it's a bit hard to expect to just replicate that. It's still substantially stronger than the one before that. And if you cast your eyes to the left, it's typical. We've got to just discount that one before and the GFC one because they were just so extraordinary. We've got other charts that we are expecting a bit of an air pocket of sorts in sort of August this year, and that's kind of laying that out before us. But we're still talking nearly 70% increase in liquidity, and we've got another chart that shows the sensitivity of the assets beside that. It may not be as extraordinary as the last time, but it's still quite extraordinary in terms of where it's got to go from here.
Yeah, and that is that recency bias I mentioned before at play again, where we go, oh, but we only got this little bit extra to move, but that little bit is a lot when you start thinking in percentage terms and what that actually means in terms of the dollars, the pure amount of injection that's coming into the economy if it plays out as that model suggests. Joe, I want to talk to you about what seems to be the elephant in the room every time we have the Fed speak, which is this potential inflation. They seem to be hinting that there might be a couple of rate cuts later in the year, but they're still concerned about inflation, somewhat understandably looking at this chart, because if the dotted line there is at 2%, we haven't made a compelling fall below that in the official numbers. They were very clear that's what they were going to require. I don't think we're going to get there.
Yeah, and I suppose like back to what our liquidity models and what we believe in, the rate cuts having lower rates does help to an extent, but it's not necessarily where we build our entire liquidity model around. I know a lot of people are watching what the Fed does, and I would argue that the cuts don't necessarily mean as much as if they were to go out and start full-blown QE again, for example. But we know that's not going to happen until they cut rates, or if they do cut rates. If you're one of those people that do believe that rate cuts matter a lot, with Powell's going to be out the door this time next year, he's gone, right? So the market's going to be forward-looking. Trump's going to pick who he's going to pick, and the market would probably assume that there's X amount of rate cuts already priced in by the time that new Fed member comes in. I think it's May next year is when they swap around. In terms of where the market's looking forward, I know you've got the bond chart coming up as well. If you look at like the 2 and the 5 year, they're currently trading below the 3 month, for example. The 3 month yield is I think it's about half a percent higher, maybe not 0.5%, 1/4% higher than what the 2 and the 5 year bond yield are, which suggests that yes, rate cuts are coming. But once again, we don't necessarily think that is the most important thing that's going to occur. The reason why we obviously have the bond charts is because we need to know how each portion of the bond yield curve is reacting. If you click into the next one, we can see that there's obviously a lot like the yields at the long end of the curve are a lot substantially higher, which they should be. But I think like from the market's perspective, they're seeing that concept of not monetary, fiscal dominance playing out until the rest of time, until something actually eventually blows up. So yeah, I don't know. What are your thoughts on it?
I'm going to use the term blow up there just as a nice little segue. Paul, if you were listening to the commentary and certainly watching what was going on, the risks were very real of a substantial escalation of the geopolitics angle into something resembling very much a world war, involving, like, when the US is involved, you didn't know where it was going to go. There's a sense that maybe that's come to an end, but you never know with these things what's actually going on. If you were looking at that chart and didn't know that piece of information, to me it doesn't look like that at all. You wouldn't have picked that at all. Do you want to just talk us through what you would normally expect in a scenario like the one we've just been through, and where the risks potentially are that it hasn't responded that way?
Yeah, it's crickets. So that it's just again reminding listeners that as bonds bid higher, the rates drop, the yield drops, and if you're in a if bonds used to be the safe haven, that's certainly not played out. So that chart is telling us that no one was diving into bonds in fear of where this war came out. Now gold has rallied, but even that was somewhat tepid. So I think there's an element of exhaustion in the market about geopolitical events, to be honest. But on no account would you have yields staying as high as they are amid everything that's going on. So it speaks yet again to gold's story over the last 12 months or longer, is the move away from the US Treasuries as a safe haven. And arguably, again, this is the US sticking its nose in to an overseas affair. There could be growing concern that around the weaponization of the US dollar. So I think it's a theme that started with Ukraine and the sanctions on Russia, and just get, I guess, expanded when we see these sorts of things happen. So there's clearly a general wariness on US bonds.
And the US dollar aspect of this, we have seen certainly weakness. Again, it's sort of the same question, really. If you were to look at the US dollar chart, you would not have thought what we'd just been through would have happened. Where's the roaring strength in the US dollar? It's not there. It's come off even a little bit, slightly more since I produced this chart a day or so ago. You look at this and go, Joe, I might ask you about this. If this was a normal cycle, this is the part of the cycle where we should be seeing US dollar strength in a typical, like we had that big move down, we should be seeing that strength. If this is all it's got, should we be watching out below?
Yeah, absolutely. I think historically you would have seen a much larger move in, as you guys have pointed out, in the dollar and in bond yields. And really, there was a little bit of a bump, but there was nothing. Like at the end of the day, like basically closed the day, pretty much closed where it had closed the day before. So, and I think back to Paul's point as well. There just seems to be a lot of geopolitical exhaustion. Like there's just so much going on, and I don't know if the market seems to sort of want to look through it at the moment because it knows the end game. But as we've been saying for quite a while, all these what you would call dips in risk assets along the way, particularly Bitcoin, have just been buying opportunities every single time, just based on the back of our liquidity model. So, we can talk about the dollar going down, and if we, for example, get a reasonable move down in the dollar, which we do expect, that's going to have huge implications on our global liquidity index in terms of nominal dollars. So we can talk about where we think that might head. I think it might even be the next chart or the chart after. So
yeah, we will discuss that. I want to bring it back to one point when we start this deep dive on the Bitcoin cycle. This idea that you just said, Joe, about every dip has been a buying opportunity. That is true during that phase of the cycle. And this is the really important part. It's the same reason that we said we were ignoring the yellow or the orange and the red on that Bitcoin chart earlier, because during this phase of the cycle, you do ignore it. It is a buying opportunity. I think where a lot of people get caught out who are new to the market or don't really understand how to read the cycles is they just then go, okay, every dip is a buying opportunity. When we get to the end of the cycle, it's not anymore, is it?
yeah, 100%. And we've got the tools that we go through every month through this podcast. We've got our Beyond the Block tools, and we've also got a few in-house tools that we use. And for everyone that tunes in every month, when we think we're getting close to the top, or when we are a bit past the top, we'll definitely be screaming from the rooftops.
Paul, you mentioned this chart before, and I think it is worth, given the conversation that we we're just having before around some of these wealth taxes and things that are being flagged all around the world, certainly here in Australia. I've been reading a number of articles about the potential for significant tax regime change. None of us like it, but at the end of the day, that seems to be the foregone conclusion. It's the result that you're going to get from a chart like this.
Yeah, and one repeated throughout thousands of years of history. So this is, this speaks fundamentally to the likes of Ray Dalio sort of thumping the table at the moment, and our own Dhruv that is big on cycles and is again thumping the table. That guys, we have the confluence of the 80-year sort of grand socioeconomic cycle, the 18.6 property cycle. There's a number of things aligning here that would indicate we're towards the end of that grand cycle, the empire type thing. So, and this just reinforces it, that we've got the masses on the dotted line and we've got the few on the black line, more particularly the gold line, benefiting from the black line.
Yep. And you've we've had interesting discussions around this as well. You back a few years ago, you look at things like the fourth turning, all these the 80-year cycle, all these things that you heard about, and you went, yeah, but I can't really imagine them happening. And then you live through the weekend that we just lived through, because that was all that this stuff was, wasn't it? It was huge geopolitical instability. It was things that you wouldn't have even thought were possible in this day and age that happen. And when they happen, you go, oh, no one could have seen that coming, but it kind of was built into the cycle.
Yeah, and they ordinarily see three things, like overwhelming debt. Well, $360 trillion of debt around the world, and many times GDP. You've got the social economic disconnect that we've got at the moment, and then you get a disruptive technology. Well, hello AI. So we've got a number of things coming together that point towards some sort of big societal economic change, and what's always, putting my gold bug hat on, what's always survived that has been gold, and now we've got gold 2.0 and Bitcoin, which really shares all the same characteristics. So if you want to be somewhere safe, it's in the assets that protect you against that.
Joe, there's a lot of conversation when we get to this stage of the cycle around price targets, and no one ever wants to give a price target, and understandably, because whatever price target you give will be wrong, almost by definition. So this is interesting for us because we feel that we can at least give some potential ranges on some assumptions of the model, that we're saying, well, if liquidity plays out the way that we seem to think it is going to play out, that it has been playing out so far, you multiply that by some of this sensitivity modeled on how Bitcoin responds, that you can actually get some sort of range of targets. Are you brave enough to sort of project out what some of those could be?
So firstly, we'll run through how the multiplying table works. So we'll just focus specifically on Bitcoin. Historically, you've had, so for every 10% move in global liquidity, you'd get, looking at that red bar, a 90% move in Bitcoin, right? So we're not going to go off 90%. We'll go off the orange bar, which is the historic last 18 months sort of move. So you're looking at about 5 times on the 10%. So if you get 10% move in liquidity, 50% move in Bitcoin. Now, what I was when you were referring back to that liquidity chart where we're sitting just above the 50 zone, and the AI modeling had us pushing out to potentially 65, 70, that's still a huge move. That is a good, 20% move, 20 to 25% move. So being conservative, we'll call it another 10% at least in the cycle. 10% on 10% is 100. So you'd expect the 10% move in Bitcoin would give us a price target of around 200. And, you have to imagine that if Bitcoin's at 200, you could probably add a little bit of speculation influence on that as well. So, you could easily push the price to 230, 240 in a blow off top. So I'll say 240, but like that can obviously change at any time based on where we think liquidity may or may not.
We've seen a couple of charts in the last couple of days. So Jamie Coots, who follows on Real Vision, will know, the chief crypto analyst there. His model, I think, was 239, so awfully close to your 240, Joey,
Yep.
as the upper. But and there's a couple of ways you can read this chart, I think. The red is what you would expect in a market. The orange is what we've seen. And it makes sense, right? Like gold's gone hard. It's actually a little bit above. Silver's lagging, and that's what it does. It comes hard home at the end. And Bitcoin, you could argue where we've got that sort of 4 left there, and we had 20% of that chart. This was the one I was referring to earlier, Chris, when we were looking at that, 20% left of change in liquidity. You're up around exactly what Joey's saying, is at around a doubling and a bit from here. So
and a lot of that can be off the back of a falling US dollar as well. So if we believe that the US dollar, it doesn't have to go down a lot. Like it's currently at 98, which is still historically quite high. Like if you zoomed out on that chart, that's still a very high sort of DXY level over the last 20 years. If it falls 5%, then all of a sudden you got 5% because global liquidity and debt is denominated in US dollars. A 5% jump in the global liquidity is huge. Huge.
So we don't rely on that though. Like we're not going to say, oh, we're going to put our target in at 239 or 239,500 because it was halfway between Joe and what Jamie had said. We're going to go, no, we then would go back to other tools, right? Like I think this is also a mistake that a lot of people make, is they try and use these price targets to position themselves for where they want to exit. We're probably using it slightly differently. I'd actually argue we're using it to suggest if the price just took off and made its way very quickly up to 500,000, it might be a bit overdone. Is that a view that
I
you would
just argue
subscribe
we
to?
don't.
It might be overdone.
We never, in any of our investment committees or anything like that, talk about targets, because targets are dangerous. Like, all we're saying is this chart tells us three of the best assets outside of Ethereum to be in this new fiscal dominated regime of liquidity are gold, silver, and Bitcoin. And yeah, we can speculate about where it might go, but we're going to be taking our cues from the science at the top, irrespective of what the number is, because that's where people get caught out. And they're hanging out for 240. Well, it may not be 240 this time because markets don't act that way. So I think it speaks fundamentally to our approach as we don't have targets.
That was actually the point I was getting to, because when you look at the last cycle, I think it was targets that really caught people off, particularly on that second pump.
Everyone was calling 100,000. It was like 89, 90% certainty it was going 100,000. And it crushed a lot of stocks.
Where would they have all put their take profits? 100,000. And when it didn't get there, they missed the entire run. Yeah.
No, dangerous stuff.
Same reason everyone was thought it was going to go to 10,000 as well. So, just been getting screwed on both ends of the trade.
But it is understandable why people think that way, because they don't have all the background and the additional tools. They're looking for one thing to hang their hat on, and they hang it on those targets because they logically make sense to them at the time. What probably is quite useful here, Joe, we were talking about this just before. If we use our own sort of version of the modelling of the rate of change of global liquidity, you can see currently we're sitting around that 6% annual rate of change, which is certainly very constructive. And if you looked at this chart, you would just say, well, because it's a logarithmic chart, you'd go, well, we're clearly going to break out two new highs, which has been our position the whole time. Unless something fundamentally changes, you would go, it's looking pretty good. However, we were commenting on this idea of a base effect that's starting to come into play when you look back 12 months at what was happening there. Do you want to talk us through that a little bit?
Yes. Sorry. First of all, I just want to touch on that point that you guys made at the start, where if we had this chart, for example, growing money supply growth growing at 14, 18, 20%, and then we had all that geopolitical news that we have had over the last couple of weeks, that could have very well been the pin that pricked the balloon, right? So because we are at that 6% growth, which is obviously positive, but it's not exorbitant. Like it's not pointing to the end of the cycle. We are getting that floor under Bitcoin, which stops it from falling too far when we do get these events. Yes, there's going to be short liquidations, but it also helps us maintain our conviction that money supply is growing, but it's not exactly low. There's not a deficiency. So we maintain that those dips are buying opportunities. Back to your point where we've got that basing effect. So if you look back to 2024 July, we did have that somewhat of a low in supply growth. It actually went slightly negative in July 2024. And now, remembering, because this is a 12-month average, you've got such a low base, and that's why we're now seeing a reasonable pickup to that 6% money supply growth. And I don't know, what would your interpretation of that be? Do you see that as a positive or a negative? I see it, it may distort it slightly.
Yeah,
because you did go from a negative to a positive within 12 months. So it'll be interesting to see how it plays out over the next 6 months, I suppose.
I think it puts a headwind on it, because the concern would be, if you think back to that heat map chart, if we don't see some actual pushing through of liquidity from those central banks really quite soon, like imminently, then to maintain that rate of change against a rising base, it needs to be still going at that rate, right? Like it needs to still be pushing forward. And the indications from the central banks seem to be that they're just waiting. How I interpret it, I think they're seeing how long they can get away without actually having to come in with the big bazookas, because they know once they do it, you can't stop that train. So that they're waiting, sitting on their hands as long as they possibly can. We know that's going to come to an end at some stage. Probably it needs to come to an end in the second half of this year, and we're about to start that. So I think it comes, but I can certainly see the potential for a hiccup or a bit of an air pocket before that happens, just simply based on that base effect you were describing.
Yeah, and if you look at it,
it's not even waiting, right? They're actively, like the ECB, UK, Japan, like they're actively, and the US, right, doing QT. Like they're trying to unload their balance sheet. So they're not sitting on the hands. They're actually got the handbrake on. So it's doing all this despite that handbrake, and as soon as they take that handbrake off, and you can totally get why they're doing it. They're just trying to get their powder dry for what they know must come.
Yep.
But then we just get other things, whether it's the US dollar, like the Genius Act. Like not many people's talking about the Genius Act in terms of that's just opened up, a whole new customer base for bills, for short-term bonds. So we keep getting other things, whether it's the bond market settling down, whether it's the US dollar dropping, a new buyer of short end bonds in stable coins. I think once they take that handbrake off, that's when we're off. But I can totally get, like, it's not breaking. Like, that is the trajectory. It's bumpy, but it's up and to the right. I think as soon as they see the cracks or whatever will be the black swan or whatever it's going to be that sees them take it off, then, you pin your ears back because they're not sitting on their hands, they're breaking.
Yeah,
and to your point, Paul, like in terms of a lot of that short-term debt issuance, like that short-term debt issuance has a lot less volatility, right? So in terms of collateral in the wholesale money markets, it's very good collateral. So we can see that even with a lot of this, well, you'd call it debt monetization, if you see those changes in the SLR and banks are out there topping up their balance sheet with short-dated debt, it's very good for liquidity. And a lot of that M2 stuff doesn't track that. That's the kind of stuff that we're tracking at the moment.
If we bring this conversation around to sort of the current Bitcoin price relative to this is that chart of the shorter term, like weekly liquidity, I would argue potentially the price is about where it should be here with that risk we were just talking about. Because if Paul's saying, the handbrakes are still on, there is that bubble risk. I think, Paul, if we were looking at this chart of our cycles, it did dip a little bit lower than what's shown there. It feels a little bit choppy. In the last cycle, we were sort of saying that we didn't think it was going to break all-time highs. It did, but only just slightly break in that last 60-day cycle. Then if it was going to really take off, it probably should have done it already, I would have thought. So how are you viewing this cycle in terms of the next short period of time? Is it likely to break off to new highs or more subdued than that?
I think there's a couple of factors. So we will beg to differ on that previous chart. I still think you need to push the brown line to the right a few months, and I know that won't be forever because people will just front play that. But
some people agree with me on that. Just for the record, I know some people watching this will say, "No, we like the fact that you don't try and forward push it 3 months because that's an average. It's not the actual
correlation would indicate that that's saying that we still have an up before a down, but in the discussion three of us had beforehand, the whole sell in May, go away, the northern hemisphere summer could absolutely see this just chop. And as you said, it went higher than we were expecting, so maybe it just has a bit of a rest by a chop in the 60-day cycle. But it ends around August, and August is when we're expecting a bit of an air pocket. So, but when I look at that previous chart, if you push it to the left, to the right, then it would indicate we've still got a higher to come before we get a bit of a dip.
And there's certainly indications that the low could be in on the sort of peace announcement. That would logically make sense that could be the low of this cycle. So I would expect probably over the next month at least pressure to the upside, but whether it breaks out of that range is anyone's guess, I suppose,
well,
at this
as we're
stage.
recording, it's 105, so it's certainly bounced off that 102.
Yeah, it's sitting much closer in the middle of that range. And just on that point, Joe, this is a piece of data that we, a source of data that we rely fairly, like we don't use it, but we find it very interesting, particularly when it looks like this. You want to just talk us through what we were looking at the last few days?
Yeah, so this is obviously a little bit out of date now because we have pushed past that 105. So it probably would have looked a lot better if we had showed this chart yesterday or the day before. But what it's effectively doing is it tells you where the longs and the shorts in the market are, right? So as we can see above the price in this chart, there's a lot of built up shorts that if the price moves in that direction, they get liquidated. So it's effectively the market's it's telling you how the market is positioned, and the market, as we know, always likes to inflict the most pain on the most amount of participants. So with all that build up of liquidity above it, you would expect, generally speaking, with nothing below it and a lot built up above it, you'd expect the price to rise because everyone's already gone short. There's no one left to go short in the market. Doesn't mean it can't go lower, but as a rule of thumb, like it's a pretty good indicator when it's that heavily skewed.
And we very rarely see it as clear as we saw it on this chart, which was only a day or so ago, where we were very confident saying, well, I think the words I was using at the time was I would be positioning for greed here, not for fear, when certainly a lot of people were positioning for fear.
Absolutely. And we're looking at some other metrics as well, some other leverage metrics. And, the liquidation map, if the price had moved up, there was, I think, 3.5 times as many shorts were going to get liquidated as longs if it moved down. So that sort of positioning, that sort of skew is like, well, it's a pretty good chance it's going to head higher.
We'll have a look at gold and silver because they've had just monstrous months, a monstrous year, really. There's been so much really pushing those prices higher. Paul, if we think about this gold chart, it really just, I wonder, and I think a lot of people wondering when they're watching this would go, is it a runaway train? Like, there's obviously reasons that it's moving higher, but should they be concerned?
Look, yeah, I mean, there's plenty of metrics to say that it's overbought, but then you've got normally bearish banks calling for, high threes to $4,000. So it's, I think it goes back to us scratching our heads over why the bond market didn't move. I think you're looking at the reason. So if we have just a complete change in the sovereign buyers or those the central banks of the world, then I don't know how you price that, because you're just taking massive participation in the biggest bond market in the world and putting it into gold. Now, I'm not suggesting that's what's happening with all of it, but it certainly seems to be a factor. And then you've just got normal people looking at what's going on and listening to their gut and saying, I need to be in hard assets because this feels like it's going to go wrong. So I don't know how we put a price target, and we don't on gold, but it's nothing.
I think it's a little bit of that wealth confiscation piece that we're talking about as well, Paul. Like, people feel safer custodying their own assets, whereas if it's sitting in whatever bank or institution, if the rules change, then what recourse do you have? You just, like, it's that bearer asset adoption that I think we're going to see a lot more of over the coming years.
Yeah. Yep.
And I think I can confidently say that the price being where it is has broken traditional models around this. So that's really dangerous to go, well, like, to my question, should we be concerned here? We should be concerned, but not with the price of gold. We should be concerned of why the price has broken out that way, because it's sort of moved past those logical retracement points to be charting new territory, and that, to the points that you're making, both of you have been making there, means something has actually fundamentally changed, and that's always dangerous to then treat it under the old regime, because the regime is different.
Yeah, yep. It speaks to our fundamental thesis that we're in a fiscal policy dominated economy, not monetary policy, and so it some time ago, I can't remember what, quite a while ago, it broke from its very tight correlation with real interest rates for this very reason, because we are in a different regime. We touched on it earlier with the impact on interest rates isn't what it used to be, because at the end of the day, we keep giving that analogy that if it's your home, right, you care, but you don't have a choice around interest rates. It doesn't direct your attention to refinancing your home if interest rates are high. You do it because you're going to be homeless otherwise. And they have a wall of debt that they have to refinance, and irrespective of what the interest rates are going to be, they have to do it. So we are absolutely in a different regime, and gold will benefit because it's fundamentally around the debasement of currency.
And coincidentally, that chart that you're talking about, Paul, with the real interest rates and the price gold sort of starting to move away from each other, diverging, coincides with Yellonomics, with what we would call Yellonomics, and a lot of issuance of short-term debt, which is exactly what's going to continue into the future.
Yeah.
Well, they have no choice on that.
Say all he likes, he's not going to do it. He's got no choice.
Yeah.
Absolutely.
Something that I've been focused on in a number of conversations that I've had, whether it's in insights or different things that we do, is around silver as potentially a play here for people who are concerned, even though I'm suggesting gold's under a new regime. Silver really hasn't broken those all-time highs, not even close really to breaking those all-time highs. And then you could argue it's not overvalued at all if you were wanting what seems like a funny thing to say, the safer play here. People push back on me on that and say, well, no, gold's a safer play because of all the reasons you've just said. But if you're looking at it from a purely price perspective, I can make an argument that silver is actually a safer way to attack the precious metals markets here. What's your thoughts on that, Paul?
Yeah, well, and you can go back to that bar chart earlier where gold was pretty much in line with its beta over the 18 months. Silver was still lagging behind. So I think that speaks to this a bit. We've got a gold-silver ratio. So this chart's well out of date. So we're up, we punched through 36, and that was a really, 35 for a lot of people was a very important resistance line, and it's punched through it and it's still above 36. But the gold-silver ratio, which again, what you're alluding to in terms of what people are looking at, well, that's dropped down to 93. Now 93 is a long way from a target that you might have around 50, for instance. So it's still looking to be the more undervalued of the two, and it does normally follow gold having a run. So if you were allocating at the moment into precious metals, then it certainly looks like it's got more potential.
Yeah, and this chart was just updated at the start of the month, and that pullback was quite significant in the GSR in terms of what it meant for as silver really pushed through that level. But that was kind of my point of it's not safe. Some people say, well, it's not safe because of the volatility that it brings into that mix. But when you look at what it historically has done, you would expect that volatility to continue to the upside.
Yeah, no, we're very constructive on silver at the moment.
This monthly macro and global liquidity analysis is brought to you by the Ainslie Group, Australia's trusted choice to buy, sell and swap gold, silver, platinum and crypto, online or in our Brisbane and Melbourne showrooms. With over 50 years of operation, we're your reliable partner in wealth management. Visit ainslie.com.au to find out more about Ainslie Bullion, Ainslie Crypto, Ainslie Wealth and the Gold and Silver Standard. Okay, we do like to provide a little bit of additional alpha towards the end of these videos where we offer our trading plan that we've been following since the start. It was a chart I put up earlier where the idea, of course, is to buy low, sell high, but really follow everything we've been talking about over the long term. We've been publishing this since the start, so all this history is up there that this isn't just a made-up number. This was, or a made-up date. This is when we actually did this trade. So that was January 10th, 2023. It has been up and to the right ever since, but the point that we're making before, we've had, 1, 2, 3, 4, nearly half a dozen, not false signals, but signals that people might have been concerned that was the end getting out, and we're still staying strong, including this most recent one. that has resulted in some absolutely spectacular gains where we've had now 513%. Now, that is over a long time. That's over, 896 days, so nearly 900 days. But annualized, that's still well over 200%. And that really highlights this point that there has been and there is no asset quite like Bitcoin for capturing those gains. It's not too late necessarily in the cycle, as we've highlighted. There's still room to go. But what's really exciting for us is actually the biggest gains are made during the bear market. So when we do get that sell signal, you sit to the side and then get to come in again at the equivalent of where we did last time, the $17,000 buy price. That's where the real gains are made, getting that buy-in. So we'll be watching that very closely and paying attention as the cycle evolves. But that's where we sit today. Look, we'll wrap up there as we usually do with sort of final thoughts from our panel. I'm sort of taking on board everything everyone said. It's really an interesting time because of what we've just seen in the geopolitical space, where even probably what was the worst case scenario, as far as I can imagine, playing out in geopolitics, and the cycle was nothing wavered. Our platform, our model, everything still performed exactly as expected, and that's very exciting for me. So that's really any doubts that might be in my mind are just shaken off by that, to say, well, it has been absolutely stress tested, and this is where we sit right now. We're sitting in a really positive position because we expected the liquidity to keep going. So, further highs ahead. Joey's told us exactly where it's going to be, so we can rely on that to the letter. So that's sort of my takeaway is up and to the right until we get to Joey's 239,000. Joe, over to you.
I wish you wouldn't say that with such conviction. It's because someone's going to watch the end of the video and be like, well, that's what it is. I agree with all that. I've been very happy with the calls that we've made over the last few months. Even last year has been just fantastic, staying in the market, buying those dips, which is basically been our message every month that we've done one of these videos since we started, and it's turned out to be a fantastic call every month. So going, as we pointed out, the next 2 to 3 months may be a little bit sideways choppy, just based on seasonality. So I'll personally continue to look at those dips as opportunities to add a little bit more.
And Paul, do you want to wrap us up with your thoughts and any exciting news you might have?
Yeah, I might have some exciting news, Chris. So we're actually very excited to announce Ainslie Wealth, the funds management part of the business, is launching its first fund. So we've got our AFSL, so we're fully ASIC approved, and launching the beginning of the new financial year, July. And it's essentially a secure exposure to Bitcoin with active management of the drawdowns using precious metals, and all of the framework that we've been going through every month. So what's been happening without you knowing for the last 16 months is we've been meeting, the three of us and the rest of the investment community, on a synthetic fund. Every week we have a meeting, go through these sorts of deliberations. And we've been running that synthetic fund now in preparation for launching the licensed. So it's a wholesale investor fund. Only wholesale investors, unfortunately, can apply and be part of it. But a very exciting vehicle, because it's really, as we've said, there's no other asset that gives that upside like Bitcoin. But those drawdowns will test anyone, I'd argue. And can see you sell at the wrong time or capitulate in disbelief. This fund just actively manages that with going to gold and silver at the right times. Holding gold and silver, you've seen how correlated they are with expanding liquidity, and then they have that dual role of the safe haven piece when things turn. So watch your space. Go to ainslewealth.com to check out that fund, and you can put in expression of interest. It really is. It's a solution to so many wholesale investors that want to be part of Bitcoin that may not be in there already, but they're scared of the volatility. We see it as a feature, not a bug. They don't know how to custody it. It's got institutional insured custody, and they often can't even bank it. So this is outside that crypto exchange space where banking is not an issue. So it's a solution to a lot of things. The back testing is quite phenomenal, and we're happy to have a chat with anyone if you reach out to us. But go and have a look on ainsliewealth.com and you'll learn a bit more about it.
Thank you for that, Paul. It certainly is very exciting. We have been working on this for a long time, or at least our modelling around this. As you can see, if you go back and look through our YouTube, many months of these updates that are using this framework. So very exciting opportunity to be able to share that with others and hopefully share in some of those spectacular gains that we just highlighted. Look, thank you everyone for watching our update for this month. Thank you, Joe. Thank you, Paul. We really appreciate your contributions and analysis today.
Thanks, Chris.
All right, thanks for having us.
As always, we value feedback and discussion. You can follow me on X at Tipper Analytics if you want to stay up to date or reach out, or post your comments in YouTube or wherever you're seeing this. We absolutely take all of that on board. We'll be back next month with the next monthly update to reassess and identify what has changed. Until we chat again, good luck in the markets.